Hello, everyone, and welcome to MACROACE with your host, Tony. I'm also the head financial analyst at FinancialJuice. And this is a recorded version of the streams. Usually, of course, I do live streams, but tomorrow or Wednesday will be Eid, which I'll be celebrating with my family for the day. But of course, I still want to give you guys the lowdown of what to expect for inflation. And of course, the Bank of Canada, which will be later on, and that will be in a separate recorded video as well. But let's get through CPI today and give you a rundown of what to expect and what the previous market reaction was before. So with US CPI, first of all, what is it? It represents how much consumers are paying for retail goods and services. And the way that's measured is you have 26,000 retail outlets, 4,000 housing units in 87 urban areas, where prices are collected on 80,000 different goods and services. So the key measurements then, you have housing, which represents about 42%, food and beverages about 14%, transportation about 18%, and medical care about 8.5%. Then you have the core CPI data, which excludes food and energy. Of course, those are the most volatile parts of the report, so you get a clear idea as to how strong or weak inflation is. Usually, the seasonally adjusted data is the preferred way to gauge how strong inflation is within the prior month, because that removes the effects of seasonal effects that include weather, production cycles, consumer spending habits, etc. So within a normal environment, the central bank isn't looking to raise or cut interest rates. Everything is normalized and the central bank is steady. The month-to-month usually takes precedence over everything else because traders are more interested in what was the strength of inflation within the prior month compared to everything else. Now, the difference between PCE and CPI is that PCE inflation places a low weight on prices of gasoline and of residential rents and focuses on the nation as a whole rather than just focusing on urban areas. So take note of residential rents because that's going to play an important part within the CPI report and also the central bank's forward guidance and what they expect for inflation in the future. How does it affect the markets? Well, usually with the dollar, if you do see stronger than expected inflation reads, that can lead to a stronger dollar because that means the central bank is more than likely to put off cutting interest rates compared to what the markets would have already anticipated them to do. On the flip side, in the stock market, if you do see stronger than expected data, particularly underlying inflation or the core CPI data, if you do see a sharp rise in the inflation data, that can lead to stocks taking a hit. And in this case, with this environment that we're in, if we do get the third month in a row of stronger than expected inflation data, that will then hit market participants in their view of where they see the Federal Reserve with their rate cutting cycle. Instead of maybe seeing the first rate cut happening in September now, that could push it back even further into towards the tail end of the year. I mean, that means from that repricing that you get more volatility, and from the increased amount of volatility, you get more opportunities that are then presented to you within the market. For the bonds, if you do see weaker than expected inflation data, bond yields can see a weaker reaction or bearish reaction because that means that the Federal Reserve may be inclined, or the markets may perceive that the Fed may be more inclined to cut rates maybe in July or June and pull back rate cut expectations. So bond yields would see a decline, and then you would see a more risk-averse move that happens within the markets. A more risk-taking moves that happen with the markets, and traders and investors jumping into the riskier assets rather than staying in the safe haven of bonds. Of course, on the flip side, if you do get stronger than expected inflation data, bond yields would go higher. Of course, in anticipation, the central bank will hold rates for longer where they are. And that means that the rate cutting cycle will be pushed back further instead. So let's look at the previous report then, looking at March at the February report. So looking at the core month-on-month read, excluding food and energy, we'd seen increases in shelter, airline fares, motor insurance, apparel and recreation. And we'd seen decreases in personal care, household furnishings and operations. Where is the economy at the moment? We have non-farm payrolls at 303k compared to 275. Unemployment rate ticked down to 3.8% compared to 3.9%. Average earnings also ticked down to 4.1% compared to 4.3%. Employment costs at 1.1%. PC price index slightly ticked up to 2.5%. Core PC prices remained unchanged at 2.8%. ISM manufacturing prices paid at 55.8 compared to 52.5. Services prices paid at 53.4 compared to 58.6. Productivity lower at 3.2%. Import prices lower at 0.3%. Export prices remaining unchanged at 0.8%. PPI year on year stronger than previously seen at 1.6% compared to 1%. Core PPI remaining unchanged at 2%. So if we look at the triggers then for the economic relief, so this is going to be quite interesting. As said earlier on, if we get the third print of inflation being stronger than expected, then that could push back the rate expectations of the first rate cut past September or cement it even further. The first scenario, if you do get data where the economists at the moment currently here looking at 0.1% deviation for the majority of the economic releases on either end, you would then get the, if we get it on the high end where it's 0.1% higher for all the figures, you would then get this scenario of the September rate cut being cemented even further. Or if you do get stronger than expected data, or let's say a 0.2% for any of the figures, particularly the core data, then that could lead to a stronger market reaction, and in this case, a bearish reaction from the stock indexes, a bullish reaction from the dollar. So ideally, what we'd want is we'd want to see a 0.2% deviation on the majority of the figures, to particularly in the core readings, to be able to see a more stronger sustained reaction. However, the reason why I say that is because the last report, and we will look at the deviations sheet, is that the last report had seen a depreciation from the stock indexes, but the market reaction didn't last that long. It had reversed quite quickly. So that's something that we need to be aware of, is that maybe, okay, if we do get the third month of data coming in stronger than expected in a row, that could be enough for data to see a 0.1% deviation. But a 0.2% deviation would definitely then cement that inflation isn't declining in the way that the Federal Reserve wants it to do. There isn't a nice disinflation that is occurring within the economy. And in that case, the scenario of the September rate cut could then become a rate cut further down the line instead. And from that speculation comes that volatility. And from the volatility, you get stronger moves and market reactions. And then that provides more opportunities to you guys within the markets. Let's look at the sentiment and views then of what investment banks feel. So with ING on April 9th, they say that catalyst for a high dollar may come from CPI, but also from various central bank decisions. The US CPI release tomorrow is obviously a big risk event for the dollar, but if consensus is right and core month-on-month inflation prints 0.3%, the room for a dovish repricing in Fed expectations should shrink further. Morgan Stanley on the 8th of April say that weak used car prices and continued gradual disinflation in rents are expected to be the key drivers of deceleration. JP Morgan say 2 back-to-back strong CPI readings are a reminder that disinflation rarely moves in straight lines. CIBC, they say that one component has been dragging its heels towards tamer levels, and that's rent. Although it's not weighted as heavily in the PCE price index that the Fed favors over CPI, relief from rent inflation will still be of importance to the central bank in achieving its 2% inflation target. But if central bankers are willing to assume that the usual lead-lag relationships will hold, then they won't have to wait to see all of the rent disinflation before their first policy easing. And it's the strength of the recent growth indicators that will instead be what limits the Fed to a modest 75 basis points of easing this year. Hence, with non-farm payrolls, which was stronger than expected last Friday, led to the repricing of the first Fed rate cut to September from June and July. Bank of America, they say that after two firm reports to the start of the year, core CPI should cool off in March. If our forecasts prove correct, it will be a confidence builder for the Fed and keep the option to cut in June alive. So again, as I said, the core data is going to be key to have a look, to keep an eye on for us as traders. But of course, all the releases that we have, the non-core data, the headline data, is also going to be key. So it's quite tough that you're having to have more focus on the core data. And if you do get a mix of data, let's say core is weaker or stronger and the headline inflation data is weaker or stronger, get a mixed report, then it means that you don't really get a clear picture, and neither will the markets. And in that case, with a confused market reaction, it's harder to pin down what you should do. Now, me personally, it could be an opportunity to jump in quickly and jump out and not stay in a trade. But even then, that will be quite risky if the data is mixed or if you don't really get any deviations, because then you're relying solely on how the market is going to move to give you your direction. Okay, so let's look at Fed views then. Fed's Bowman said on April 5th that progress on lowering inflation has stalled and expects lower progress in cooling inflation this year. Fed's Logan said that inflation data is more important than jobs and GDP right now, and there is no urgency right now for the Fed to cut, and that we have time. April 4th, Kashkari said that it's possible the Fed won't cut this year if inflation stalls, and of course, the release for tomorrow or Wednesday will be quite key to confirm whether that could be the case or not. On the 20th of March, Fed's Powell said that we don't know if this bump on the inflation road, if this is a bump on the inflation road or something more. There's some confidence that lower market rent increases in housing will show up over time. I'm just not sure when that will be. And finally, Fed's Bostic April 3rd said that I'm still forecasting one rate cut this year. If the economy evolves as I expect, I think it's appropriate to cut rates in the fourth quarter this year. And I think we won't be back to the 2% inflation target until 2026. So let's look at the market pricing. March 18th, Fed swaps price in less than 50% odds of a June rate cut. April 5th, Fed swaps shift full pricing of a rate cut to September from July. US interest rate futures pare back June odds of a rate cut to 54.5% after the jobs data, according to CME FedWatch. So this is the last release that we had for inflation data. And you see the initial weakness that comes from the stock indexes and strength from the dollar. Data was stronger than expected by 0.1%, excluding the CPI month-to-month. But you'll notice, and I did take a short trade on this, believing that it would be enough to keep going down, considering the strength in the data, and it was stronger than expected. But you can see that it wasn't going to work. And then I was then I was kicked out of that position. The initial first trade worked well on the first part of the spike, but the reason as to why you'd seen this reversal within the markets is because markets were still expecting June to be the first rate cut, rather than pushing back the potential for a first rate cut. So that's what held markets together, because they believed in what Powell said about heading towards or the belief that inflation is heading towards the Fed's 2% goal. Hence, you see this market reaction. So let me kind of skip forward and go ahead. So yeah, there we go. The markets, you've seen the initial pop on the dollar yen, and then decline on the S&P, on the stock indexes. And then after that, the markets went reversed the other way and continued pricing in June for the first rate cut. So if we skip forward, let's look at the deviations then. That's something I want to kind of go through with you guys and have a little look at. Here were the deviations for US CPI last time around. So you can see in the past where there has been a 0.1% deviation, and data has been stronger than expected, the market reaction has been a bit more sustained to a degree. It hasn't reversed so quickly. Whereas here on March 12th, you can see the initial decline from the stock indexes, from the S&P and the Nasdaq and the Dow. But then after 10 minutes of trading, or 10 minutes of the release, you'd seen that the markets have then moved back up, or were actually up, and had reversed their initial loss. And after about 30 minutes of the release, which is represented in the blue brackets, you can see that it was still up, and it was up by 42 ticks on the S&P, 91 on the Nasdaq, and 71 on the Dow. And same story with the currency pairs. You can see the mixed reaction that had occurred. A strong initial reaction from the dollar yen of 74.5 pips towards the upside. But after 10 minutes of trading, it was down. And then after 30 minutes of the release, it was back up again. So this is the reason why I'm hesitant to look at what the analysts are expecting, looking at the highs and lows of a 0.1% deviation from the majority of the releases, and looking instead at a 0.2% deviation to have a stronger confirmation of either inflation being stronger than expected or weaker. But as I said earlier on, it doesn't mean that a 0.1% deviation with the current narrative that this will be that if it is the third set of inflation going higher than expected, that the markets won't have a strong reaction like they have in the past. But the last print that we had kind of puts that in the back of your mind, thinking, well, maybe it won't happen. It won't be as strong of a reaction if we do get a 0.1% deviation. But it still could be enough to convince traders that the September rate cut will be cemented further, and a 0.2% deviation to the high side, to the upside in inflation expectations could mean it could be pushed out even further. Now, of course, you get the inverse reaction, where there is data that is weaker than expected. Then you could get the scenario where the rate cuts is then pulled back to June or July, depending on how strong the depreciation is with the inflation data. And then you would be looking at least at a 0.1% deviation on that side there, and for an even stronger market reaction, a 0.2% deviation. However, talking about that, in November 14th, this is, see, sometimes the releases, you can see here, a 0.1% deviation wasn't enough, and you might need more of a confirmation that inflation is headed lower. You can see here, back in November, there was the initial move down and then up. Markets were quite mixed there, so that's something just to be careful of what could happen. But with this scenario, a decline in inflation would be welcome news and break and stop the occurrence of the third inflation print being stronger than expected, or a re-acceleration of inflation, which of course the Federal Reserve doesn't want, and neither would the market want to see. In regards to pricing for the initial rate cut, of course, it presents an opportunity to day traders from taking the opportunity from the volatility that comes with the repricing of a Fed rate decision. But that's just something that we need to be aware of how and this is why the deviations and ranges spreadsheet is useful, because you can see how the markets have reacted in the past, and you can see where there might have been triggers or releases, or a date of a set of releases where the markets might not have reacted in the way that you think they would react. So you're giving yourself more preparation. The data, hard data there, right? Being very precise with it gives you that help. And I hope it has for you guys so far. So that is the prep for Canadian CPI. Excuse me, not Canadian CPI, US CPI. I hope you found it useful. Don't forget to give the video a like, share and subscribe to us. Share the video, subscribe to the channel, give it a like, get the word out there. I know, apologies, I'm not going to be there tomorrow, but I'm hoping that this information that I provided you has been useful and informative. And of course, don't forget, FinancialJuice is where the data will appear. You can keep an eye out on what's going on within the markets, what's going on, what's being said by central banks, or if there's any geopolitical events that are occurring, any shifts in narratives, the China-US trade war tariff trade war, if that kicks off again. Who knows? But you can keep up to date with everything that's going on around the world that's affecting the markets all in one place via voice here, which is in the button that I've just clicked there, and via your text feed here in the center. Okay. And the left hand side, you have your economic calendar as well of the upcoming economic releases for the week ahead and for the day. All right. So for those of you who haven't subscribed to the MACROACE mailing list, then of course you might be watching this tomorrow rather than tonight, then, or maybe later on in the day tomorrow. Then don't forget to subscribe to the MACROACE mailing list, and you can stay up to date with what's going on, what we'll be covering, what are the major releases, the big events that you should be focused on, right? That are going to provide you with the most opportunity to be able to take trades. Of course, if that's what you want to do, it's up to you. But give you the insight as to how these market reactions can cause big reactions, enough for you to have the opportunity to take them and make trades, and hopefully profitable trades. All right, thank you very much. I will see you in the next recorded video for the Bank of Canada.